Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris. Good to see you again.
Hello, Lee. Good to see you as well. I hope you had a good holiday.
Yeah, it was. Really enjoyed it. I'm sure the listeners have noticed we've skipped another week here as a result of being on holiday. But I think we all need that little bit of a break. So as you are on one now.
A short break, but you've come back to the misery of the budget. You come from the sunshine to the grey, the darkness, the autumnal UK, and the misery of our latest budget. It hasn't encouraged a lot of people from both sides of the political spectrum.
I'm sure the listeners would have expected that this podcast would be centered around the budget. So what's your thoughts, Chris? What's the impact on AIM? How has it affected you and the business, fundamental?
Yeah, it's an interesting budget. So prior to it, everybody was fearing the worst for AIM. They thought they were going to withdraw the business reliefs in entirety. And as a result, the AIM market and many stocks we follow have been incredibly weak for weeks. You've been seeing so much selling. So many people have sold ahead of the budget. Come budget day, we didn't have the total withdrawal of business relief on AIM shares. That's what the tax rate's based around. We had a sort of watered down version. So there will still be a tax break. It's not 100% relief. Effectively, there'll be 20% inheritance tax applied to business relief shares. And it's not immediate. Clearly, a lot of people feel it's going to be immediate. So it's only going to be April 2026. It's worth clarifying, I think, on this point as well. It was quite a confusing message when Chancellor Reeves announced this. I mean, it wasn't clear whether AIM shares would also get the £1 million tax relief, and they won't. So there won't be 1 million inheritance tax free, as far as we've read it, that you will just benefit from a lower rate of inheritance tax on AIM shares. And they would still need to meet the criteria, the business relief criteria. So investment will need to be in trading companies. The shares will have to be held for 2 years or more on death. So far as we're aware, all the same, the existing rules will apply. Quite frankly, I'd never seen a rally on AIM as strong as we saw after the budget. The market itself was up circa 4%. I've never seen a budget reaction as positive for the AIM market, but I think that's really a reflection of how weak it was before, which is a shame, but it has been weak. You've seen crazy share price movement, and you saw crazy movements on the day as well. It's just so little liquidity, so little interest lately on AIM shares, which is a shame because tax breaks aside, valuations have never looked as attractive on AIM, which is really encouraging. Negatively, post-April 2026, will people really be incentivized enough to hold, given the added risk of smaller companies? Will a 20% inheritance tax break on it be enough to encourage them into AIM shares? Who knows? I think many financial advisors may be more reluctant to suggest that to their clients. Clearly, some clients really won't like the thought of a so-called double tax and may be happy to go for a tax break. If you've got quite a large estate and you save 20%, well, the sums involved can be quite substantial. But yeah, it's not ideal. It wasn't. What did you think? It wasn't a very encouraging budget. What do you think?
No, I don't think it was very business friendly at all. I was quite disappointed by it, and in particular around the national insurance. If you're a large corporation and you're looking to invest and you're looking to employ 1,000, 2,000 employees, would you look to the UK? Does the Labour government look a business-friendly government?
Two solutions. I wouldn't look to the UK. I'd look anywhere else to source. And secondly, I'll be ploughing money into AI to avoid employing anybody. The incentive here to invest more in AI is heightened, isn't it? You're going to see plenty of ingenuity to avoid incurring additional employers' NI. It's ludicrous.
Which begs the question, how do you think AIM stands up now to other markets? As an example, there's two ultimate stocks that have reported this week, Alphabet and Garmin, have done amazingly well.
This is the issue. At the end of the day, AIM has to be a viable and interesting investment prospect for people. It's a lot smaller now. The AIM market's smaller. There are a lot of really good companies. There have been loads of takeovers. The companies that are left are doing really well. But are they doing well enough? Are they growing fast enough? Are they interesting enough? Really, isn't it? It's an investment prospect to say, well, they're a better prospect than the Alphabets and the Garmins of this world, two of our ultimate stocks, two of Investors Champion's ultimate stocks. And Alphabet's just reported 30% growth in earnings per share, and no fudgy numbers there either. No dodgy numbers. These are clean numbers. So it becomes a tougher decision. And certainly people say, hold it, I can save 20% tax, or do I want to go for a strong, lower risk technology giants or giant companies with the perspective of meaningful outperformance, but no tax saving? Ugh, it's a tough one. I think many people will just say, I'm going to go for the growth, the low risk tech giants rather than the smaller minnows on AIM. But AIM companies themselves, there are some great companies. We talk about them a lot and doing really good things. They've got to do more to promote themselves to everyday investors. And they've got to be honest. They've got to be brasher with their promotion as well, but honest. And the London Stock Exchange as well, as I think the head of AIM recently was trying to highlight, that AIM companies make good investments. They need to do more as well. They're raking in a fortune from data fees and everything. They need to start to do more to promote these small companies to the wider investment base. And it's a tough job, but they should be able to do it. There's money out there. Given that AIM's been underperforming, the underperformance has been driven by this concern. It's hardly going to encourage people. Now 20% is a bit of a 50-50, isn't it? Is it worth saving 20 when my AIM shares have been underperforming dramatically? So why don't I get out and go into US technology stocks or UK main market? And so it's going to be a vicious circle. People getting out, AIM will perform more, which will encourage more people to get out. It's not encouraging at all. I mean, they've maintained the brakes on EIS and VCT, so that's positive. But there are a lot of small growth companies on AIM, many of which might want to come back to the market to raise more money and to be on a market. The market itself needs to be attractive. And when there's added risk, you need some added attractions. The tax rate was an attraction. That's now going to not be anywhere near as attractive as it used to be. The tax tail was wagging the investment dog of all these AIM shares. That's why nobody was buying and a lot of people were selling. If we've got some stability now for a few years, which is under 2 years, that's going to be positive. But this is a warning. This is a warning to AIM companies, smaller companies. If you want to be noticed, if you want to, and to the London Stock Exchange as well, if you want to get noticed, you need to do more. You need to communicate better. The exchange needs to be better. It needs to be zappier. It needs to attract more investors. I don't think it's been doing enough in that regard. So come on, this is your warning. There's still a tax break. Do more. Encourage more greater interest in these stocks because a lot of them are worth it. There's some terrible businesses, but every market has questionable businesses, but some really good ones as well.
Yeah, as we've mentioned there, Alphabet and Garmin. Is there a risk that people might start to weigh up the 20% tax break versus the returns of Alphabet, Garmin, etc.?
I think there is. So get your act together, AIM companies. Get your act together because
I guess that's what you said. You've got 2 years to get your act together.
Yeah. See what can be achieved.
Yeah.
Because there are countless places for people to invest now. And Alphabet shares are trading at 19 times forecast unadjusted earnings, clean earnings. That's not bad for a company that has been growing at circa 20% earnings growth. It has issues as well. It's got a government review and of its so-called monopoly status. So it's not a free ride. It's got risk as well. Just dealing with one other thing on we had another question on the budget, the impact.
Yeah.
And somebody asked, I thought it'd be worth bringing this up. They weren't clear if the status of AIM's shares within a SIP, because obviously private pensions, i.e. SIPs, are also going to fall into the inheritance tax loop going forward. And this could be really brutal because a lot of people have accumulated quite a lot of money in their pensions. Previously, this could effectively continue in perpetuity. And someone has asked, would they qualify for the 50% relief break, inheritance tax relief, i.e. only paid tax at 20% and not at 40%. Now, we're not entirely clear, but from our reading of it, generally, a SIP is its own collective structure. It's not in the individual's name. It's effectively in trust, pension in trust. So we don't believe that you'll be able to benefit from AIM shares from a reduced inheritance tax rate for AIM shares held within a SIP. That's our reading. I don't know. We suggest you take tax advice, but that's our reading of it.
Yeah, absolutely. Seek tax advice for that. But your initial thoughts, that's how it looks.
Yeah, we believe so. Yeah.
Which actually leads me on to a query from one of our previous podcasts around the dividends. And I think you might have expressed that you would rather see companies invest in their own growth as opposed to paying out dividends. And I'll mention his name. It was Steve who emailed in and he said established companies should pay out a dividend, especially those companies that have gone through that growth period. They were established, they had their assets, they were chucking off lots of cash. His thoughts were that he believes they should be paying dividends.
Yeah, he liked the certainty of the dividend rather than didn't he say the volatility of the share price?
That's right,
The problem is I'm not averse to that. I sympathize with Steve. Thank you for your question. The issue is for many UK companies, they've been paying out excessive dividends, well in excess of what they should have done. And let's draw attention to Alphabet, Google. This is a business that could have easily rested on its laurels. It's a technology company. It's raking in a fortune. Look at the cash flow. It's absolutely mountainous. It's got nigh on $100 billion, sitting in cash. But you can't stand still. Google now Alphabet gives out a small dividend. It buys back shares regularly. It in turn is also having to invest a lot, in its case, AI. My issue with a lot of legacy UK companies is the dividend has been of paramount importance because a certain fraction of the shareholder base has wanted it. And they've been often excessive. So I'm not averse in companies paying dividends. I just think some of them are paying out excessive amounts of money and haven't been investing in their growth. And therefore, they're not even going to exist in 20 years' time. That's the fear we're drawing attention, Steve. That's our fear. A lot of these businesses are not investing in enough. So sooner or later, you'll see diminishing returns. And it's just poor capital allocation, really. There have been very good ones. A company like Halma, which we're not holders, but Halma has been a very effective investor and capital allocated, still pays out a dividend, growing dividend. But it's also been investing, acquiring, and it's now a multiples of where it was 10 years ago. So I'm not averse to dividends, but this consistency of dividends is a fallacy because, you're getting your dividends, but look at your capital growth, it's non-existent. Your capital values decline. Your business is effectively just stripping itself down, cutting itself down, death by 1,000 cuts. That is the risk with many UK companies. Garmin, another one of the stocks you were talking about, the maker of the smartwatches and GPS track watches and outdoor leisure products, is a case in point. It's having to invest like mad. It can't. By the time it's launched one product, it has to refine it and bring out the next. It's totally living on the edge. But look at the growth that business has generated over recent years. It's absolutely staggering. You think, oh wow, products are going to get obsolete. No, because it keeps inventing a new one, and it's paying small dividends, and it's buying back shares.
Yeah. If anyone does have any questions or queries you'd like to put forward towards Chris, just email them in at champion@investorschampion.com and we can discuss them.
Probably non-political questions as well.
Yeah,
I think
absolutely.
we've been as political as we've ever been on this call.
Yeah.
But
yeah.
such is the way with the budget.
Yeah.
But preferably company questions or AIM questions or main market or investing questions. Let's move on from the politics. Hopefully.
Yeah. And I think, next week we'll get back to companies and the shares. And it was just this week, we wanted to put something out regarding the budget. I'm sure people wanted to listen to Chris's thoughts on the budget. Chris is currently enjoying a short break in Suffolk, and I've not long got back from my holiday. So hopefully you enjoyed that little short podcast episode there. Next week, we'll be back to normal companies, shares, AIM market, etc.
Great.
Thanks, Chris.
Thanks very much. Look forward to it.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.